Hi, my name is Arun, and in this my new video, I'm going to talk about the wheel strategy and how it looks on the Degiro platform. I'm also going to cover what are the related costs of getting in and getting out of the trade. But let's start with the disclaimer first. I'm not a financial advisor, so please consult before investing. There are possibilities of unlimited losses when you're dealing with uh, options. Before we go into the wheel strategy, let's quickly look at selling puts and call options. In this slide, there are a few things I want to highlight. In case options are in the money below your strike price, you will be assigned shares. You will be needing a cash for the assignment, and the profit while selling puts is limited as well, as you can see here. Yes, this is limited to your premium, and the max loss in case the share price goes to zero is what you will have. So in this case, in this example, the Nokia is trading at the strike price was 3.5. So at least in you will have a loss of 350 euros per contract. So if you have sold two contracts, then you will have a loss of 700 euros in case the Nokia share price goes to zero. By writing calls, you are giving someone else the right to buy stocks when exercised. Again, the profit is limited to premium. Max loss is unlimited since share price can go to infinity, of course, in theory. But in the wheel strategy, the unlimited loss is protected by the shares owned by you already. Yeah. Let's now talk about the wheel strategy. In simple terms, the first step involves selling put options, as you can see here. Uh, Important here is that we sell put options against the stocks which we don't mind owning in the long run. So I'll be doing this wheel strategy in the shares which I'm happy owning. If the share price drops suddenly to very low, the possible outcome of the step one is number one, the contract has expired worthless. In this case, congratulations, you have collected your first premium. Start with step one again. Yes, so you repeat. Step two is that contracts are in the money. In this case, congratulations again. You have been assigned the shares at the strike price. And this case, you will be needing the cash in your account to buy these shares. I think important to know here is that now you own the shares at a lower price, that is strike price minus the premium collected. You have completed the step one. Now let's go to step two. The step two involves selling calls against the shares which has been assigned to you in step one. The following possible outcomes are there. Number one again, contract expires worthless. Congratulations again. You have collected your second premium. Repeat the step two in this case. In case the contracts are in the money, shares are called away from you. Now you have successfully completed the step two and we go to step three. Congratulations, you have completed the wheel. Start from step one again. And as people say, rinse and repeat. Yes. So this is a wheel strategy in very short. Yes. Let's look at how this would look like on Degiro. If you want to know how to sell puts and sell calls, please refer to my earlier videos. In this slide, I'm only going to show step one, which includes assignment and related costs. Let's look at it now. So what I've done is I've sold two call options, two puts on Nokia at a strike price of 350 on 27th January. For that, I received a premium of 40 euros, and the cost of selling these to put was €1 50 cents, 75 cents per contract. So I've sold two put contracts, if you can see here. Okay. Now, at the expiration date, the Nokia was trading below my strike price. In this case, I was assigned Nokia shares at 3 euro 50 cents. Since I had two contracts, which is 200 shares, so I was assigned 200 shares of Nokia at the rate of 3 euro 50 cents, which is 700 euros. So I need to pay 700 euros to get that assignment. If you see here on that day in my account, I had 635 euros. After assignment, it was minus 66. So I have to fund my account. Of course, I have a margin account, but I'm not using it. So I funded my account with additional money. But important thing to also know here is that the assignment of the shares, there is a cost as well. So you will be paying 1 euro per contract for getting that assignment as well. Okay. Let's now look at the step 2 of the bill. So again, very quickly. So step 1, we sold 2 puts on Nokia, collected our first premium here, 40 euros. We paid a 1 euro 50 cent cost. And then there was an assignment which happened where we paid 700 euros for getting those shares. There was an assignment cost of 2 euros. And then, as in step 2, I sold 2 calls. It is covered since I own these 200 shares. I was able to sell it at a strike price even higher than the strike price where I was assigned. Of course, I had to wait 2 weeks because immediately after I was assigned, the share price dropped to 330 or even 3 euros 30 cents, or even at one time 3 euro 20 cents. So I waited. It jumped back, and then I sold my call at 16 euros per contract. So if you see here, I collected my second premium here, 32 euros, by selling these 2 calls against the 200 shares which I was owning. So this call expired worthless on 19th March, 2 days before, and for that I paid nothing. So in the end, now I have collected my second premium. Let's now look how it looks like in totality. So I still own 200 shares, as you can see. My next step is to sell call again this and collect more premium till this is called away from me. Okay. Now let's look at what is the return on investment. So as you have seen, I received my first premium at 20 cents, 2 contracts which are 100 shares each. So I collected 40 euros as part of step 1. I was assigned 2 contracts at 3 euro 50, which is 700 euros. So this is the money which I have to pay. Now the cost basis for my shares was 700 minus 40 because this I already collected. So I owned the shares not at 700 but at 660 now. Okay. Generally, people who want to buy shares for long term, they're also using this strategy to buy it at a lower price than the market. So they will put a strike price which is 5 or 10%, and then at least wait for that to be. Of course, if the uptrend is too much, you have a risk that you will not get the shares at all. But usually, this is also an approach people use. Okay, once these shares were assigned here, I've sold 2 calls at 16 cent each, which is again 200 shares. I collected additional 32 euros, as you can see here. And now my new cost basis for the shares is 660 minus 32. So this is my price of the shares which I'm owning now. Okay. Yes, here. And then uh, as I'm recording this session, the current share price today is 3 euros 42 cents. So with this, the current price of the shares is 684. So I paid 700. The price today is 684 if I'll sell it today. And if we look at the total profit, so 700 is what I paid. 684 is what I will get. And then meanwhile, I collected 40 euros and 32 euros from those 2 premiums. So overall, I have a net profit of 88 cents. And in a 45-day, the return of investment is approximately 0.57%. Basically, my investment money was 700 euros. So I collected a 12% return on this. So what are the possible scenarios now from this? So one scenario is I keep selling calls at 3 euro 50 cent strike price, because this is a strike price where I was assigned. Of course, I will have a higher return of investment because the extra premium collected will be added to the 88 euros. This another scenario is if I'm lucky and the market is going up for the Nokia shares. So, and in case I manage to sell calls at 380, and then my shares are called, or my shares are called at this strike price. Of course, I have collected a premium again, but then I have added this additional 60 euros. Yes, because now someone will pay me 760 euros against the 700 which I paid to buy it. So this will additionally add that amount into the overall profit which I've collected. That's why it is also called a third income or three income strategy as well uh, for this setup. The third scenario, I think this is important to understand. The share price can go down. Yes. Then wait, uh, if possible, because it's sometimes not possible to get good premiums. Yes, and please keep in mind, yes, that's why it is important that you trade in the shares, because you wanted to own those shares in anyways. Yes, you don't mind owning those shares anyways. Yes, so this is the key here. Of course, sometimes if you are doing this strategy in a dividend shares, the price has dropped, but you have those shares, then you earn dividend while owning these shares. So that's why it's sometimes also called the fourth income, uh, which you can get out of this. And the most important thing which I want to bring, which happened, yes, with me as well, it's not always possible to sell calls at the assignment strike price. Like example, when the share price dropped immediately after the assignment, I was not getting any good premium to do the step two of the call, so I waited for 2 weeks. Yes, and then at least I was able to sell the call at even a higher strike price. But you can always do trades, so it does not stops you. You can get out of your trade by selling shares at a lower price if this is what you want, or you can also still make a little profit by selling it above your cost basis of the share. Because now this is 628, maybe I'll sell it not on 3.5 strike price, but maybe 3.4 or maybe less, and I can still make some money. Yes, but for long run, generally the expert says that try to stick to the assignment strike price or higher. But yes, in the overall, you need to understand what are the risks and what you need to do basically for your trades. Yeah. In case you have liked the video and content, please like and subscribe. Thank you. Yeah. Ciao.